I want you to do a piece of arithmetic with me right now. Think about how much you have paid in rent since you moved into your current place. Not this month, all of it. Every month, every year, added together. For most people watching this, that number runs into the tens of thousands of dollars. For some of you, it is 6 figures. And now I want you to ask yourself one simple question. Where did all of that money go? Not in a philosophical sense. Literally, where did it go? Because it did not vanish. Money does not vanish, it moved. And the place it moved to is not your bank account, not your retirement fund, not any asset that you own. It moved to your landlord. And every dollar of it, every single dollar, was doing something for them that it was not doing for you. This video is about that transfer. It is about the mechanism by which rent payments convert your labor, your hours, your energy, your time on earth, into someone else's wealth, at a rate and scale that most renters have never had described to them in plain language. It is about the specific financial architecture that makes your landlord richer every month you pay rent on time, and why the conventional advice about home ownership, just save up for a down payment, just get on the property ladder, just stop renting and start building equity, is simultaneously true in its direction and almost useless in its specificity, given what has happened to housing markets over the last 4 decades. But before we get to the math, and the math is genuinely shocking once you lay it out, I want to sit with the feeling that renting creates. Because I think there is a specific emotional experience that long-term renters know intimately, and that does not get discussed honestly in financial conversations. It is a feeling that sits somewhere between futility and humiliation. Futility because you can feel, month after month, that you are running on a treadmill, expending enormous effort and producing no forward movement. And humiliation because the cultural narrative around renting in America is saturated with the implication that it is a temporary condition, a life stage you pass through on the way to real adulthood, real stability, real arrival. And if you are still renting past the age where the narrative says you should have bought, there is a specific kind of quiet shame that attaches to every lease renewal. That shame is not an accident. It is the product of decades of cultural messaging from the real estate industry, from financial media, from the political architecture of homeownership subsidies that has positioned renting as failure and ownership as success. And like most financially loaded shame, it does a very specific kind of damage. It makes the structural causes of the situation invisible by making the personal causes feel overwhelming. If you are renting because you failed to save enough, failed to be disciplined enough, failed to do what adults do, you have no reason to look at the system. You have only reason to look at yourself. And the system benefits enormously from that misdirection. What I want to do today is follow the money. Not emotionally, not politically, mathematically. I want to show you exactly what your rent check does when it leaves your account, what your landlord's balance sheet looks like as a result, and why the gap between their position and yours widens, not despite you paying on time, but because of it. And then I want to talk about the system that created this arrangement, the forces that have made it more extreme over the last 40 years, and what, if anything, can actually be done about it. Let's start with the math. The math, equity capture, amortization, and the wealth transfer. Nobody talks about. Let me describe a transaction. Your landlord owns a property. They purchased it, let's say, 10 years ago for $300,000. They put down $60,000 20% and took a mortgage for $240,000 at 4% interest over 30 years. Their monthly mortgage payment is approximately $1,145. They charge you, the tenant, $1,700 per month in rent. So right away, before we even start talking about equity, there's a $5-100- and $50-$5 monthly spread. That spread is their gross operating income before maintenance, taxes, and insurance. But that spread is not the wealth transfer I want to focus on. The spread is obvious. The equity capture is the part that most people have never had explained to them. Here is what happens to that $11-100- and $40-$5 mortgage payment every month. In the first year of a 4%, 30-year mortgage, approximately 79% of every monthly payment goes to interest, meaning it goes to the bank, not to equity. Only about 21%, roughly $240, goes toward reducing the principal, which is the actual ownership stake in the property. So in month 1, your landlord makes their mortgage payment of $1,145. Of that, roughly $900 goes to the bank as interest. Roughly $240 converts into equity in the property. And every dollar of that equity was funded by your rent check. Let that land. Your landlord paid nothing out of pocket this month. You paid $1,700. $1,145 of it covered their mortgage. $555 went directly into their pocket as income. And $240 of the mortgage payment became an ownership stake in a building. An ownership stake that belongs entirely to them, funded entirely by you. You generated their income and their asset accumulation simultaneously, and you received in return the right to occupy the property for 30 more days before you are required to do it again. Now let's run this over time, because the equity math gets more dramatic, not less, as the mortgage ages. Over a 10-year period on that same mortgage, at that 4% rate, your landlord's equity has grown from $60,000, their original down payment, to approximately $132,000, assuming no appreciation in property value. That is $72,000 of additional equity built over 10 years. Almost entirely, not partially, not mostly, almost entirely, funded by your rent payments. The bank provided the leverage. The landlord provided the down payment. You provided the cash flow that converted the leverage into ownership. You are the engine of their wealth accumulation. And your balance sheet at the end of those 10 years reflects exactly none of it. But we have not yet introduced the most powerful variable in the landlord's wealth equation. And it is the variable that has converted rental property ownership from a reasonable investment into a generational wealth machine over the last 40 years. That variable is appreciation. Property values in the United States have increased at an average annual rate of approximately 4% over the last 50 years. In major metropolitan markets, the markets where most renters live, because those are the markets where most jobs exist, the appreciation rate has been substantially higher. Zillow data shows that home values in cities like San Francisco, New York, Seattle, Austin, and Miami have doubled, tripled, or more than tripled in real terms since 1990. Here is what appreciation does to the landlord's balance sheet. Our landlord bought the property for $300,000. At 4% annual appreciation over 10 years, that property is now worth approximately $444,000. Their equity, which was $60,000 at purchase, is now $60,000 of original equity, plus $72,000 of mortgage paydown, plus $144,000 of appreciation, a total of approximately $276,000 on a $60,000 investment. In 10 years, funded almost entirely by your rent. Their return on invested capital, their actual cash deployed, is 360% over 10 years, or roughly 17% per year, compounded. That is not a particularly exceptional property in a not particularly hot market. That is the basic math of how landlords build wealth at scale. And now the comparison that makes this genuinely uncomfortable to sit with. The renter, after 10 years of paying $1,700 per month, has paid a total of $204,000 in rent. They own nothing. They have no equity. They have no claim on the appreciation of any asset. Their balance sheet in the category of housing wealth reads exactly zero. Your landlord's net worth, in the housing category alone, increased by $216,000 over the same period. You provided the cash flow that made that possible. And the system that structured this arrangement, the mortgage finance system, the property tax system, the zoning system, the political economy of home ownership, was not neutral about the outcome. It was designed to produce it. The system: how housing became a wealth machine for owners and a treadmill for renters. The arrangement I have just described, in which renters fund landlord wealth accumulation at scale, did not emerge naturally from free market dynamics. It was constructed through a series of deliberate policy decisions, financial innovations, and institutional developments that systematically privilege ownership over renting, and that systematically transferred the benefits of rising property values from the people who occupy homes to the people who hold title to them. To understand why renting is as financially punishing as it is, you have to understand the system that made it that way. And the system has a history. The foundation was laid in the post-war period. The Federal Housing Administration, expanded dramatically by the GI Bill in 1944, created the 30-year fixed-rate mortgage as a mass-market product. Before this, mortgages were typically 5 to 10 years, with balloon payments and 50% down requirements that restricted ownership to the already wealthy. The FHA loan made homeownership economically accessible to a broad middle class, in theory. In practice, the FHA's manual explicitly used race as a criterion for loan eligibility and neighborhood classification. The agency systematically denied loans in mixed race and predominantly Black neighborhoods through a practice called redlining, while guaranteeing loans in racially homogeneous white suburbs. The result was that the post-war wealth-building mechanism of homeownership was available to white Americans at scale and denied to Black Americans at scale, and 40 years of compounding appreciation in those assets produced a racial wealth gap that mathematical models can trace almost entirely to that policy decision. The tax code is the second pillar of the system. The mortgage interest deduction, the capital gains exclusion for primary residences, and the depreciation rules available to landlords all function as government subsidies for ownership and investment, subsidies that renters do not receive. The mortgage interest deduction alone costs the federal government approximately $30 billion per year in foregone revenue. The bulk of that subsidy flows to higher income households, which are disproportionately owners. Renters who are disproportionately lower income receive no equivalent subsidy. The government is spending $30 billion per year to help people who already own property, while the housing conditions of people who cannot afford to own deteriorate. This is not a partisan observation. It is the documented distribution of a federal policy. The 1986 Tax Reform Act introduced passive loss rules that made residential rental property one of the most tax-advantaged investments available to upper-middle-income households. A landlord can deduct depreciation on a building, a paper loss, against rental income, dramatically reducing their taxable income even when the property is generating positive cash flow and appreciating in value. This is a mechanism by which the tax code transforms rental income into effectively tax-sheltered income for property owners, while the wages and salaries of their tenants, income earned through labor, are taxed at full marginal rates. The person doing the work pays the higher rate. The person collecting the rent pays the lower one. This is not accidental. It is the structure of a tax code written by people who owned property. The 2008 financial crisis introduced a third actor whose impact on the rental market has been profound and underreported: the institutional landlord. In the years following the crisis, as millions of foreclosed single-family homes came to market at distressed prices, investment firms, Blackstone, Invitation Homes, American Homes for Rent, and dozens of others purchased those properties at scale, converting them from owner-occupied housing into rental inventory. Between 2011 and 2017, institutional investors purchased over 200,000 single-family homes in the United States. They did so using cheap capital available to large institutions, but not to individual buyers, often outbidding families with all-cash offers in markets where first-time buyers were already stretched. The homes that might have provided the entry-level ownership opportunity for a generation of potential buyers became, instead, rental inventory managed by corporations whose explicit business model is maximizing rent extraction from the people who occupy them. The consequence of these three forces, the exclusionary history of mortgage access, the ownership bias tax code, and the institutionalization of the rental market, is a housing system that has been structurally optimized to transfer wealth from renters to owners, and to ensure that the barrier between renting and owning is as high as possible for the people with the fewest resources to clear it. The median down payment for a first-time homebuyer in the United States is approximately $62,000. The median savings of a renter household is approximately $5,000. That gap, 12 times the available savings, is not a personal finance failure. It is the output of a system that has been building that gap for 80 years. I want to name one more mechanism because it is the most recent and arguably the most insidious. It is the phenomenon that housing economists call the financialisation of shelter. Housing, historically, served two functions. It was a place to live, and for owners, it was a store of value. Over the last 30 years, a third function has been added. Housing has become a financial asset class, managed by institutional capital as a yield-generating instrument. When a corporate landlord holds 10,000 single-family homes as a portfolio, the occupants of those homes are not tenants in any traditional relational sense. They are yield-generating units in a financial model. Their rent is revenue. Their housing stability is irrelevant to the model. The model is optimized for return on invested capital, not for the human conditions of the people producing that return. The result is a rental market in which pricing is set not by local supply and demand in any meaningful sense, but by institutional return on capital targets that have no relationship to the wage levels, the financial circumstances, or the actual lives of the people being asked to meet them. The exit strategy in conclusion. What is actually available to you? I want to be precise about what I am and am not going to say in this section, because the exit strategy conversation around housing has two failure modes, and I want to avoid both of them. The first failure mode is false optimism, the advice that tells you to just cut your spending and save for a down payment, as though the gap between median renter savings and median first home prices is a motivation problem rather than a mathematical one. The second failure mode is fatalism, the conclusion that because the system is rigged, nothing can be done, which produces paralysis rather than navigation. The honest position is somewhere between those poles, which means being specific about what is actually within reach, at what timelines, under what conditions, and what structural changes would need to occur for the math to become meaningfully more navigable. Let me start with what is genuinely within the reach of individual action, because it is narrower than the personal finance industry suggests, but not zero. The most important individual variable in the renter-to-owner equation is not the size of your income, it is the gap between your income and your fixed housing cost, expressed as a percentage. Every percentage point you reduce your housing cost ratio creates capital that can compound toward a down payment. This sometimes means geographic decisions, accepting that the city you currently rent in has a price-to-income ratio that makes ownership mathematically inaccessible for your income level, and that relocation to a market with a lower ratio is not giving up but recalibrating toward a solvable problem. The price-to-income ratio varies enormously across American cities. In San Francisco, it exceeds 25. In several mid-sized Midwestern and Southern cities, it is below 6. Ownership in a lower ratio market, accessed via remote work or industry relocation, is a fundamentally different financial proposition than ownership in a coastal market, and the difference in outcome, in terms of equity accumulation and long-term wealth, over 30 years is very large. The second individual level move is to become a precise reader of the rent versus buy calculation rather than accepting the cultural narrative that buying is always better. This is the insight the New York Times rent versus buy calculator captures well, and it is the one that conventional wisdom consistently gets wrong. In markets with very high price-to-income ratios, buying a home is not automatically the superior wealth-building strategy, particularly when you account for the opportunity cost of the down payment, which is capital that could otherwise be invested in broadly diversified assets. The buy versus rent decision is not binary. It is a calculation with specific inputs: purchase price, down payment amount, local appreciation rate, mortgage interest rate, opportunity cost of capital, likely tenure in the home, and it produces a different answer in different markets and at different life stages. Treating it as a calculation rather than a cultural obligation sometimes produces the counterintuitive result that renting and aggressively investing the difference in specific high-cost markets and for specific tenure lengths, the superior financial strategy. But I want to be honest with you about the limits of individual-level strategy here, because the numbers in the down payment gap section of this video are not navigable through personal finance optimization for a large proportion of the people watching. When the gap between available savings and required entry costs is $50,000, no combination of budgeting, frugality, and investment returns closes that gap on a timeline that keeps pace with appreciation in the markets where opportunity exists. The individual level exit from the renter position for a meaningful portion of the renter population requires either structural changes in housing markets or structural changes in the income distribution. And those are not personal finance problems. They are political economy problems. Here is what those political economy solutions look like in practice, because I think they deserve to be named rather than gestured at abstractly. Zoning reform, the loosening of the single-family-only zoning that covers 75% of residential land in most American cities, is the single most direct intervention available to reduce housing prices by increasing supply. The research on this is unambiguous. Cities that have materially increased housing supply through upzoning, Minneapolis, Auckland, Tokyo, have seen rental price growth significantly below comparable cities that have not. Zoning is determined locally. Local elections are determined by turnout. The people most directly harmed by exclusionary zoning, renters, are the least likely to vote in local elections that determine zoning policy. That gap in participation is one of the most consequential civic behaviors in American housing economics. The expansion of community land trusts, social housing programs, and other non-market housing models deserves mention because they represent the most direct structural response to the financialization of shelter. A community land trust removes land from the speculative market entirely. Housing built on CLT land is permanently affordable because the land appreciation that drives conventional housing prices is captured collectively rather than privately. These models exist, they work, and they are chronically underfunded relative to their demonstrated effectiveness. Advocating for their expansion through local government, city council representation, and housing authority decisions is not abstract political activity. It is the most direct available intervention on the structural problem this video has been describing. I want to close by saying something about the shame I mentioned at the beginning of this video. The shame that long-term renters feel, the sense that they have failed to do what capable adults do, is the most effective tool the housing system has for keeping its structure invisible. As long as you believe that renting is a personal failure, you will continue to direct your energy towards self-improvement and away from the system that produced the conditions you are navigating. The system did not emerge from natural law. It was built, piece by piece, through decisions made by people who owned property and who understood, with or without explicit acknowledgement, that the rules they were writing would benefit people like them at the expense of people who did not yet own. Your rent check is not evidence of your failure. It is evidence that you are participating in an economy whose housing architecture was designed before you, arrived, and in ways that were not designed to benefit you. That is a different kind of problem than the one the cultural narrative describes. And it requires a different kind of response, one that includes honest personal finance calculation, yes, but also honest political and civic engagement with the forces that determine whether the math ever becomes navigable for you or for the generation that comes after. Your landlord gets rich while you pay their mortgage, not because they are smarter, not because they worked harder, and not because you failed at something they succeeded at. They got there first, or they inherited the position from someone who did, in a system that compounds advantage at every step. The question is not whether that system is fair. It is not. The question is what you are going to do with a clear view of how it works. That is what this channel is for. If this gave you a clearer map than you had before, share it with someone who is paying rent right now and blaming themselves for it. Subscribe for more of this, and I will see you next week.